All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Jumping on here to respond to a question that was sent to me yesterday, and wanted to kind of dedicate a short video to it, as it is a little bit longer response. But before we do that, you can see S&P futures just took a sizable drop right here, from 32.95 down to 32.83 on 40,000 volume on the S&P future. Just monster volume here came in. It was announced that the U.S. is going to keep tariffs on China throughout, until after the U.S. presidential election. Excuse me there. So that announcement here has, pushed markets down. It's kind of a light reaction, to be honest, to that type of news. We have the deal being signed here, this week. So, back in the news with that. But you can kind of see where things sit. It's not exactly breaking ranges here, but is putting a little downside pressure on the market for the moment, and it could be something that continues. If we look here at the FXI, which is the Chinese ETF, it's having a similar, reaction in terms of magnitude, in terms of, volume. That has, really kind of crept into it here. So we'll see how that kind of plays out, and what kind of things come from that. But I want to pull up a chart, and there's this chart here because I'm going to talk a little bit about not trading, not trading at all. I'm going to talk a little bit about the nest egg, right? What people call their retirement savings, or their money for the future, essentially. And many people put money into it from time to time. Sometimes employers will match it. Other people will do different things there with it. And there's tons of advice about it out there, right? I don't have to go very far to find tons of advice, right? I can keep an eye on MarketWatch, right? And almost every single day there will be an opinion about what to do with my nest egg, right? Should I put it into a money market account? Should I put it with this fund manager? Should I put it with that fund manager? Should I keep it in cash? Should I buy Russian stocks, right? There's opinions all over the place here about it. And when it comes to the nest egg, there is no one right way, right? It's one of those where you could find the perfect way in hindsight, but in the current environment, real time, right here, right now, there's no one right way. But I want to kind of share with you here an experience that I was able to witness, and share with you the advice that I give my father-in-law. And both of them are in, both my father, who I'm going to talk about, my father-in-law, who I'm going to talk about, similar ages, coming on retirement. In fact, my father-in-law just retired, and, have choices to make. And there's been certain things I've said over the years to them that I continue to say to them, and I will continue to say to them, because they're not traders, right? They're not trading it. They're not trying to manage their own money. They're not, trying to get in there and, when the market goes up, let me sell some stuff, and if it pulls back, I'll buy some more. They're not playing any of the timings here of the market. But my father was involved with his nest egg, and started to take a little bit of control of it, more so watching than anything else. And we got here to 2007, and he's like, yeah, I don't know what to do with it. I probably should do something with it. And he just kind of let it go, and he watched it go down, and he would talk about it. He'd be saying, I'm just going to let it go. It's got to go back up, right? And then it took another big drop. He saw his monthly statement, right? Because that's how most people watch their nest egg, the monthly statement. And he said, ooh, ouch, right? And he knows what's coming up. He knows retirement. He can't give up a ton of it, right? And most of these nest eggs are invested in the market, in general. So market up, they go up, market down, they go down. And obviously it can be to certain degrees. But, he looked at it and said, oh, man, this is a little too much of a loss for me to look at right now. And then he saw it go down a little bit more. He said, I'll ride it out till the end of the year. And then the end of the year comes, January comes, and then February hit, and it was just bleed, bleed, bleed. He got his statement. He said, I can't take it anymore. I can't take it anymore. I can't lose anymore. And got out. And he said, all right, I'll get back in, when there's a time. And things started going back up. And throughout this period of time, right, you could probably guess what was going through his mind, right? And it was one of those where, okay, I got out near the bottom. All right, fine. I can live with that. But, what do I do now, right? Because here you are. You're popped out right here. You wrote all of this. So what's in the memory bank? The memory bank remembers this. And so every uptick the market makes, what's he thinking about? Well, when's the next one of these? When's the next big drop? All right, I'll wait for the next big drop, and then I'll get back to you, right? He says, I'll just wait for that. Then it goes up, then we get a little drop. He's like, well, all right, this is the start of the next big drop, right? It's going. We're going to get the next big drop, and then he watches it go, to a new high. He goes, man, it's recovered. Everything it's lost, and I'm out. What do you think he's feeling, right? Pretty demoralized, pretty much the heck with this. I don't want anything to do with this type of thing. But I'm not going to give up, right? Not going to give up. And then he watches it pull on back again. He goes, all right, here's the next big one. I'll pay attention. Europe's going to collapse. It's going to, we're going to have this problem, that problem. And, it's going to pull on back and I'm going to get my opportunity again. And what's it do? It goes. And then he's looking at it here, and he goes, man, stocks are at all-time highs. He sees the news reports. All-time highs are in, great to go. Everybody's in. Look at how much the market's up in the last few years. And you can imagine what he's thinking. Thinking, man, I missed all of that. I rode the hard down. I rode the stuff back up. I can't take this anymore. The heck with the market. And he backs out. Just says, you know what, I'm not going to try this. I'm not going to pay attention anymore. I'm going to do something else with my money. And, a CD, there it goes. How many people go through that type of experience, right? Some people, it's a long, drawn-out process. Other people, all of those emotions will come in the course of a year, right? And the market's very good at no matter what decision you make, and no matter how right that decision was for you at that time, to say, yeah, you were an idiot. You were wrong. See, you should have. Market could do that even if you make money, right? I promise you, had my father stayed in and rode this uptick and gotten out right here, today, be looking at it going, man, he wouldn't think about all the money he made, be thinking, man, look at all the money I missed out on. Right? That's everybody's mentality. And it's a normal mentality, and it's why, most people don't get involved in the market, and why many people who do get involved end up leaving the market, because it is a noisy reality, and something that when you turn on the news, when you turn on the information services, it's always one emotion or the other. It's always everything's going to go up, 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 or, ooh, things are going to crash. There's always something to worry about. Man, what about, China and the U.S.? What about this? What about that? What about Iran? What about Russia? There are a million different variables and factors, and, it can wear after a while. right now. Let's just say you popped out of your nest egg right here, or put it in a money market account, or, not involved in the market the last couple of years, right? It's very easy to look and go, man, I missed out. I missed out on a lot. And make a decision based on that emotion of missing out. And when it comes to dealing with a nest egg, like a retirement, there's no value in that type of mentality. There's no value in that type of thinking. It's very detrimental and can cause you to make wrong choices for you at that time. Because the reality is, right, the right choice to get out right here for you at that time, when you made that decision to get out, that was the right choice for you. Whatever happens next doesn't mean your choice was incorrect, right? It doesn't mean your choice was invalid. It doesn't mean, over panicked or anything like that. No. You had a great run. It was nice. All right. It was time to take some off, let things cool down, let things reset. Yeah, you avoided some of the volatility. Yeah, it's a little bit higher now. But in deciding what to do, does what has happened really matter? Right? It doesn't matter. It's not something that should even come and factor in. Because we can go back and we can look at the market in 1980, and you can look at how much the market's up since 1980, right? It starts to become exponential with the markets when you look over, decades, right? And it will likely continue to be that way. Yep. Could something change? Yeah, it could. Could there be lost decades? Yep, there will be. But, over the course of time, until capitalism falls, the chances are exponential growth in markets. Why? Because of inflation and that natural process of inflation. And so what do you do with it right here, right now? Well, you have to make a decision that you're comfortable with. That you say, hey, I am decidedly comfortable with this decision, and I'm willing to take on a certain amount of risk. And so from a nest egg standpoint, the first question you have to ask yourself before making any decision, where to put your money, how to allocate your money if you have, an IRA or 401k and you can distribute it in different things, you have to say, how much am I willing to risk? Right? What am I willing to risk? Once you answer that question, now some things can happen. Because if you're making choices and say, well, I'm going to put it here and I'm going to put it there and I'm going to do this and I'm going to do that, but you don't have defined what you're willing to risk, tomorrow when you see the market down, what are you going to think? Uh-oh, did I make the right decision? Then the next day the market's up. Oh, maybe I did. Then the next day the market's down. Oh, man, should I? Right? You're going to go through that emotional roller coaster, which is just a gnarly place to be. It's not fun at all, right? It's one that is just absolutely ludicrous. And so you have to define what your risk is. Now, I did something, right? And you guys have heard me talk about this. But when my daughter was born, I bought some Disney. I bought some Disney stock here for 2007, right? And I bought quite a bit. As much as I could at the time. And I started buying a little bit more each and every month. Now, I did not have a risk tolerance. In fact, I looked at it and I said, if it goes to zero, it goes to zero. But this is Disney. As she grows up, she's going to, be able to use this to start getting involved in the markets, pay attention to the markets, and all that jazz. And I put money in. And I put money in. And I put money in. My risk tolerance was, I didn't care. I knew this was a long-term thing and something that, it might go real low first and then might come back, and ultimately at the end it may not make anything. But I wasn't putting money that was, was it important money? Yeah, it was. But, super serious, okay? And so I could have that. And that was a nice place to be. And I mean, I remember watching it drop and, my wife is like, are you sure about all this? I'm like, no. I'm not. I'm not real sure about all this. Every day I look at the markets. The markets are collapsing, and it's a, it's banks are imploding around the world and all of that, and the financial system is gonna, go to hell in a handbasket. And I just looked at it. I said, yeah, it could go to zero. I don't know, but you know what? I kept with my strategy. I didn't worry about the ups and the downs, and ultimately last year, on the big uptick, I said, okay, enough's enough. I've taken it. And have taken some of that. I'll wait for a more major pullback and then look to be a buyer. But yeah, so far no real massive pullback that I can really approach. So can you take that approach with a nest egg? No, probably not. Right? Especially as you kind of get a little later in life. It's just you don't have that time. You don't have that risk tolerance, right? So you need to be able to define what is your risk tolerance. And once you do that, you can employ a strategy. But bottom line, being out of the markets for extended periods of time, and I'm talking 3, 4, 5 years, historically just doesn't pay. Unless you're top and bottom picking, historically it simply doesn't pay. And so if you're not managing your money, if you're not, doing all that, then, you look and you say, okay, I've got to, have some in, right? You don't have to go all in, but, you got to have some in. And let's face it, for all the fear-mongering that's always out there, we could look at markets that are doubled once again 3 years from now, right? And you say, well, that's ludicrous. Well, when the market was at 170 in 2016, right, and had been at 170 several times, if you would have said in 3 years the market's going to be doubled, people would look at you and say, you're an idiot. And here we are. Right? All the problems, all the issues, all of the election stuff in the U.S., all the stuff with the U.S. and China, stagnation in some of the economic areas, hyperinflation in some regions, deflation in others, Brexit, all of that stuff. And, still. So it's one of those things where you define your risk tolerance, and let's just say I had a nest egg that's completely out. And I manage mine, and I've talked a little bit that, hey, I have a good portion that's out, a good portion that's out. And for me, right, I'm willing to wait for a correction. I don't hold my breath every day and go, is this the start of the correction? Is the correction happening? No, right? All right, market pulls back 7 to 10%. Great, now I'll start to look at it and go, all right, is this perhaps something bigger, or is this somewhere where I can start to add some more, right? And it'll be that simple for me. And so you can take that approach. Taking that approach is a big risk. Because you know what? May not get the correction. It may not happen. Market may go up another 10% before it happens. And then goes up 10%, finally corrects, and I go, man, I didn't get as good a price as what was, back then. One of the more comfortable areas to go into if you're worried about, bigger pullback or something like that is into a higher dividend yield type strategy. That way look, even if the market pulls back aggressively, I'm making 4% a year, I'm making 3% a year or something like that, depending on the strategy and the risks of that strategy. And so you can kind of get into that area of the dividend to give you a little bit of comfort zone there with it. But as far as, well, do you go put it all in now? And, as far as the immediate timing right now, right? Just think about how many things have happened over the last 10 years that could have roiled the markets royally, that have benefited the markets. And think about all the millions of possibilities that could happen in the years to come, right? Yeah, we could get hit by an asteroid. We could see nuclear war. We could see all these different scenarios. Those risks aren't going to go away. They're simply not going to go away. But not being involved in the markets to one degree or another when it comes to a nest egg that you're looking to grow just doesn't make a lot of sense, financially. And it's something where, yeah, peeing out for periods of time, a few years here and there, sure. You got to do what you're comfortable doing, but at the same time, you can't be overly conservative there and be in a position where, where, let's face it, you're not going to reach the goals that you want to reach taking that strategy that you're taking. Now, if you can reach the goals you want with that ultra conservative strategy, great. Go for it, right? Different people have different levels of risk tolerance and all of that kind of stuff. And, you always hear, well, the younger you are, the more risk you should take and all that jazz. And it just, at the end of the day, there's some sort of financial wisdom that contradicts everything you're going to hear, and wisdom start to stack on each other, and sound advice starts to contradict each other, and at the end of the day, it comes down to doing what you're comfortable with. And what you and your spouse or your significant other are comfortable with, and running with that, and saying, look, this is the right decision for us now. We could be just starting on a period of unprecedented economic growth around the world, right? One of the really interesting things that we have seen over this bull market, right? Because historically, bull markets last 7 to 10 years and then they fall. Well, a lot of that because of the economic cycles. But as years go by, as those in power have more incentive to keep stocks up and to minimize any sort of recession, the powers of recession have, been mitigated, right? We probably should have been in a full-blown recession back here in 2016, right? But we see the authorities, they have incentive to push things higher. They know the tools, the study, the information, the data is all there for them to deal with it. And, they can minimize some of these. They can't minimize all of them, right? We saw that with the financial crisis in 2008, 2007, 2008. But, in a big way, a lot of these things can be mitigated, and we've seen that happen. And, you look at negative interest rates in so many parts of the world right now, and, you go, well, where are the other options? For investors, it is the stock market. And the bubble that is the stock market, or that some people call a bubble, could just be starting to be blown. And we can see this stock market up 400, 500% 10 years from now. And, there is a really good argument to be made for that. So being all out, being totally out in any period of time, yes, you do that when you're comfortable, but, over the long haul, doesn't really pay off. I mentioned at the beginning of this video, I would talk a little bit about my father-in-law, because he always asked me, how should I allocate? How should I allocate? How should I allocate, right? And for years, it was small caps, small caps, small caps. Go small caps, go small caps, go small caps. Every time we talked, even after some pullbacks, small caps, buy small caps, buy small caps, right? About 2 years ago, changed my tune, and I said, no, big, large caps, big multinationals, big, those are the allocations. And when we talked over Christmas, I said to him, emerging markets, emerging markets. Go get involved in emerging markets. And why? Well, look at what the S&P has done over the last 10 years, right? Look at what emerging markets have done. And when you look at valuations, we could see some of these emerging markets really take a big explosion of the upside, and we could see a very strong global rotation out of U.S. equities and into emerging market stocks. Now, that doesn't mean U.S. equities go down, but does mean emerging market stocks will be outperformers. And heck, we talked about that at the beginning of this year. So, that's kind of where I look. And so, hey, I've kind of just switched that with my father-in-law and said, hey, emerging markets, emerging markets. Now, he's not taking every dime and all in emerging markets, just like he didn't do that with small caps, but he goes in positions a little bit differently there with that. And look, is there anything about, go put it in small caps and he's calling me every day? Well, what do you think now? What do you think? No. These are multi-year, long-term trends where he understands very well that, hey, if the markets take a nosedive, everything he has is going to take a nosedive. That's just the reality of the situation and the risk factor that's there, with that. But you can look at different environments and go, okay, these are going to be the outperformers, just based on some of the long-term valuation metrics, and those are still very valid. And I know a lot of people think, well, the market's driven by news. It's driven by, and yes, in the short run and on a day-to-day and minute by minute, hour, right? I mean, even here just today, just now, market driven by news. Yeah, we had some news, right? And it took the markets down. And the markets are still drifting on lower here with that news. And could it affect people's risk tolerances going forward? It really could. But is this something that's a nest egg type game changer? No, not at all. It not even close, and something that is not even a factor. When looking at these things. So I hope that helps, at least answer some of the questions there on, how to deal with a nest egg and, kind of what to do here with that. And, bottom line, I can't tell you what to do, but, I can tell you what I'm doing, and, it's different than what my father-in-law is doing. And, we just have different, tolerances and expectations and everything else. So great. It doesn't mean one's right, one's wrong. You have to do what's comfortable for you, and ultimately define what your risk, what you're willing to risk. And once you do that, it's a lot easier of a strategy going forward. Thanks for hopping on. Have yourselves a fantastic one. I'll be back on with you here in about 20 minutes, but I'll only be on video for about 5 minutes. I'll just do a quick video. We'll take a look at the scans, the challenge, and go from there. Thanks for hopping on. We'll talk to you soon. Take care.